Everybody, and welcome to this webinar, which is on the winter economy plan. What does it mean for the self-employed? My name is Andy Chamberlain. I'm the Director of Policy at IPSE, and I am going to try to turn on my webcam so you can hopefully see me as well as hear me. And I'm joined today by my colleagues, Ryan Barnett, our Economic Policy Advisor. Are you there, Ryan?
Yeah, you can see me now. Yeah.
Yeah, we can see you, I think. And Alistair Hutchison, our policy development. Hi, Alistair.
Hi, good afternoon.
So hopefully you can see the front slide in front of you and you can hear us talking and you can see us as well. If you could let us know that you can see and hear everything okay in the questions box, that would be very reassuring, because as always, we're doing this from remote locations. And so this technology seems to work fine every time, but it's just reassuring if you let us know that you can see and hear us okay. And while you do that, I will just talk us through what we're going to be talking about here today. So this is all about the announcement that was made a week ago last Thursday, so about almost 2 weeks ago now, from the Chancellor in the House of Commons, where he announced what's become known as his winter economy plan. And this is where we learned about the new SAYS extension, the self-employed income support scheme extension. We didn't know that was going to be extended, so it has been extended, but on different terms, and we're going to talk a lot about that and in depth around that. Also, the sort of probably the biggest announcement of it all was the job support scheme. This is essentially the replacement for the furlough scheme or the coronavirus job retention scheme. And this is the one that if you work for your own limited company, you can, we believe, though we're still checking, we're still getting this verified, you can make use of this, and we're going to explain how that scheme works. And we're also going to talk about some of the other measures. So there was more tax deferrals, and there was some changes to the repayment schedules of the bounce back loans as well. And we know that a lot of IPSE members have taken out bounce back loans. And finally, we're just going to update you a bit on what we're saying around all this stuff, what we've been doing, who we've been talking to, etc. So without further ado, I'll just move us on to and finally, do please ask your questions. If you've got any questions for us at all, we've had a couple of questions in already on the email, which we're going to address. But if you've got any questions as we go through here today, just put them into the questions box, and we will either answer them as they come in if it's relevant to what we're saying, and we will also leave some time at the end just to go through the questions. So we're going to race through it, so we do like to answer as many questions as we can as well. So just quickly then, so what this plan was all about was really the government looking at the winter ahead, recognizing that infection rates were on the rise again, and so it covered job support and tax and loans, essentially saying it's going to be a tough winter. What can we do now to help businesses survive? That was the aim of what the Chancellor was announcing. Also worth noting that the autumn budget has been cancelled or postponed. There is not going to be a budget this year, I'm pretty certain. There certainly isn't going to be. We all thought there was going to be a budget in November. Around the time this announcement was made, it became clear that there is not going to be a budget, which is possibly a good thing, given that we've done some webinars here earlier in the summer, talking about how there's a lot of suspicion that there might be tax rises. I think without a budget, he won't be putting up tax rises, I hope, I think, but we will almost certainly get a budget in the spring. I suspect we might get a budget in March next year. Nothing's confirmed, and so we're still looking out for that and thinking about how we're going to respond and influence that budget. The idea of this winter economy plan is to evolve from the first phase of the coronavirus response. The first phase was the job retention scheme and the SAYS scheme as well. So it's really about continuing with that, but there is a subtle difference in tone. This is now all about helping viable businesses, with the Chancellor saying things, as you'll have heard, like, I can't save every business, I can't save every job. So whereas before there was the phrase that he used was, we're not leaving anyone behind, which actually he did, but he was saying that he didn't. Now he's saying, no, some people are going to lose their businesses and lose their jobs, and we're just going to try and help a handful of those that we think are viable. But that's basically the aim of this, so quite different to what we've had before. Okay, I'm going to hand over now to Ryan to talk us through the self-employment income support scheme extension. So Ryan, over to you.
Cheers, Andy. And I noticed today that the three of us have dressed very, very similarly. And in fact, you and Alistair seem to be wearing exactly the same clothes. So sorry for putting the audience off of that. Without further ado, well, sorry, what was that, Andy?
My collar was sticking out as well, quite scruffy. Apologies. Got to get this sorted.
So as Andy said, there has been an extension to the SAYS scheme. I'll go on to the eligibility criteria in a second, which are effectively the same as the other SAYS grants that were put in place in the summer. So those of you that have seen these webinars and read up on them will probably know quite a lot already. And firstly, the most important thing really for the moment is that the second SAYS grant, which covers the period up to August, 3 months to August, is still open to applications until the 19th of October, and that is worth 70% of your average monthly trading profits. So you've got 2 weeks essentially to apply to that if you haven't already. There have been a lot of applications, and I doubt there are too many people who are eligible who haven't applied. So the new SAYS extension, which follows the JRS sort of extension, which Andy will go over shortly, will come out again in 2 sets of grants covering 3 months that will be backdated. And this first one will cover November to January. So there is a weird period again.
Oh, it looks like we've lost Ryan.
You might have lost Ryan's sound there. Ryan, I don't know if you've knocked your microphone. Are you able to?
I think he might have dropped
He's
off
gone
altogether.
the video as well. Okay, I'll take
You're
over.
right to speak to this bit, Andy, now.
Yeah. Apologies. So look, apologies for that, everybody. So this second SAYS grant is a continuation of the first one. As I said before, we didn't know that we were going to get any extensions to SAYS. So on one hand, we were pleased to get something. But on the other hand, we realized there was 2 sort of big disappointments from it. One is that it will be down to just 20% of historic trading profits. And secondly, there was no change to the eligibility criteria. So just on this 20% figure, first of all, the way that that's calculated is it looks at your previous tax returns and it says, okay, you earned, let's say you earned £10,000 in the tax year, which was 18-19 tax year, and that's the only one you've got. So we're going to break that up into quarters. So that means you've got 2,500, and we're just going to give you 20% of that, which is 500 quid. Previously, in the previous SAYS, it was 70%. And in the initial phase, the initial SAYS 1, the first ever grant that was paid out, it was 80%. So 20% is a lot less than it was before. And this 20% figure is in line, they say, with the job support scheme. The first, there's going to be 2 of these payments. So the first one's going to cover the 3 months from November to January, and that's going to be at 20%. The cap is 1,875. That's the maximum that you can get out of this grant. The second one, they haven't actually said how much that one's going to be yet. So there is some wiggle room there for the government. If they decide 20% is not enough, they might want to put it up. We're going to be pushing them to do that. So that hasn't been decided. It could go down. It could be that the government say they're not going to do that. They're going to go down 10%. Who knows what they might do? But at the moment, what we know is for this first one, it is set at 20%. Okay.
Can you see me now?
Oh, you're back, Ryan. Hi.
I am back.
I know you really moved on from that first slide, Ryan. Do you want to take over here?
Yeah, sure. And I don't
sorry,
know.
Andy, if you just go back one slide, I think you've skipped slightly.
Oh, right.
Yeah.
Sorry.
Yeah, so apologies for that. Yeah, the horrible moment where you have no idea whether or not it's everyone else or you, and you're sort of staring into a blank space. But I imagine Andy's covered most of that
All I've done
slide.
is talk about the 20%. So if you go through the eligibility criteria, that'd be good.
Well, yeah, I mean, the other thing with the 20% is that that's not very much money at all. It only works out to 625 quid a month, which is what I was going to point out, which is pretty paltry, really. And I doubt, I mean, if you look at the SAYS statistics for those that applied for the last grant, the average application was only £2,900. So if you extrapolate that over how much is available this time, you're talking about maybe £237 a month, which isn't very much at all. But and I'm sure you covered a lot of that sort of stuff in my absence. As I said before, the eligibility criteria are very similar to exactly the same as the previous SAYS grant. So you need to have had tax returns, or well, tax returns will be applicable, but you need at least 18/19's tax return to have been filed, and you need to have trading profits below 50k, and you must be actively trading, and at some point you're going to have to tick a box that says you have been affected by COVID and therefore have had less demand, and your grant will be subject to tax and national insurance contributions when eventually you do make a self-assessment claim.
Ryan, we've had a question actually on this actively trading term from Tony Lennon, who frequently attends these webinars and who I know who works at Bectu. And Tony, I hope you're still watching, because I think it'd be good to get you on one of these webinars. I think I've said this before, but sometimes you've left by the time I've got round to answering your question. But thank you for your question. What Tony said is, look, what's your understanding of the term actively trading? Because there seems to be an implication that this is now different to the previous SAYS schemes. And I agree, the government seems to be putting more emphasis on this. Essentially, this is all part of their viable business strategy. In other words, just because they're using historical data. So it might be that you were gainfully self-employed in the year 1819 and therefore qualify for the SAYS grant. But what they don't want to do is give you a grant if you've basically given up or stopped trading altogether because COVID completely wrecked your business. However, there's still lots of wiggle room for working out, I'm sorry to use that phrase again, working out what it really means, because you could be out there looking for work, just not getting any. Are you actively trading when you're doing that? I don't think this has been very well defined. So, Tony, you've picked up on a good point there, and we're going to be trying to seek better answers from the government to get more clarity on what this term actively trading really means. Sorry, Ryan, go ahead.
No. I mean, and there's also a question. We had one, I can't remember, but we had a couple of questions over the summer as well about whether or not this applies to like loss-making businesses. Because obviously, if you're actively trading and not making any money, can you still claim? Or if you've started up a business in the last 18 months, you can claim, but you're not really trading. You're still sort of looking for work, raising investment, maybe. Can you access the SAYS grant? And Andy, remind me, because you, out of the three of us, have gone through the application process yourself. The first SAYS grant, was there a box or an eligibility criteria that said you need to be actively trading that you needed to tick, or was that added in for the second grant?
So in the first one, I don't think there was. There was something slightly more in the second grant. And there was also more about your business has been adversely affected by coronavirus the second time around. Actually, that was there the first time around to an extent as well. But when they first announced it, that wasn't going to be there. And then suddenly it was in there. So they are tinkering with this stuff as they go along. There is a fact sheet available on this new SAYS scheme. It's about 1 page long, but it doesn't answer all these kind of questions. It simply states these facts. Now, I'm sure the government are going to be issuing more guidance on this. But at the moment, some of these questions remain slightly unanswered.
Andy, I think, yeah, do you want to take over with the JRS?
Sure. So just on that SAYS scheme, before we move on from it, for us, our reaction to this was that the big disappointment was actually around there was no change to that eligibility criteria. It means that if you are new to self-employment, you don't get anything. If you historically earn over 50k, you don't get anything. If if less than 50% of your total income came from self-employment, you don't get anything. And actually, we think these are the areas that need to be addressed, and especially company directors. If you happen to work for a limited company, you're not, SAYS doesn't apply to you. Now, you can make use, or you could make use of the job retention scheme, which was the furlough scheme, but you needed to furlough yourself to do that. It didn't take into account dividend income, which meant it wasn't very advantageous. Nevertheless, lots of contractors did make use of it because they had absolutely no work coming in, and something's better than nothing. And that, of course, is due to end at the end of this month. And this new scheme is all about what comes in at the end of that. When the furlough scheme ends, the government have been under a lot of pressure to say, well, what are you going to do next? Because otherwise you're going to have an awful lot of unemployment and an awful lot of redundancies. So they've brought this in, the job support scheme. It opens on the 1st of November and it's going to be available for 6 months. In order to make use of this scheme, an employee has to have been on the payroll of the company before the 23rd of September. You don't have to have been on furlough before to be eligible for this. So if you've never made use of the furlough scheme, it doesn't matter, you can still make use of this. But this date, the 23rd of September, is something that I'm interested in, because I'm not clear whether you have to have made a payment to yourself via the payroll from your company, basically make an RTI event is what they call it, paid yourself a salary payment before the 23rd of September, but since the 6th of January. And I've been asking Treasury for an answer to this question, and I will get an answer eventually, and we will post something on our website. But I know that for many people, they might pay themselves one annual payment and do it at the end of the tax year. This caught a lot of people out with the furlough scheme. There was a date there, which is the 19th of March. If you didn't make a payment to yourself before that, you didn't get to use the furlough scheme. This could catch out some other people. So I'm trying to clarify whether the payment could have happened before the start of this tax year, in which case you could go back to that old one and say, yeah, I've been on the payroll of my own company, I've made a payment. So we're seeking clarity on this. We're also seeking clarity generally on whether company directors can make use of this if they are basically for themselves. That is not explicitly stated anywhere in the government's rhetoric around this, but we believe that you can. That is our understanding right now. Again, we will have more clarity on our website as soon as we get it. But our understanding is that you will be able to make use of this if you're a company director on your own, inside your own company. Let's see how it works then. So what you have to do is you have to work for at least 33% of your normal hours and cover this cost yourself from your company at your normal rate. In other words, you have to carry on paying your normal salary to yourself, and you have to work. Now, we did have a question in from Stephen, who works in the aviation sector, limited company director, working in the aviation sector. Of course, famously, aviation has been brought to its knees during this pandemic. So he's had no work at all, and he's been furloughed since March. And he says, look, I want to make use of this new JSS scheme, but can I pay myself the 33%, but then do some training instead? You know, does it matter if I'm not generating income? Stephen, I think the answer is you absolutely can do that. Yeah. So we're still looking for clarity, as I say, overall, that a company director can make use of this scheme, but we think that they can. And I think that as long as you pay yourself that 33%, then you could be working on marketing or whatever. It doesn't have to be generating income into the business, that work that you're doing, for you to make use of this scheme. Okay. Then you've got the remaining 2/3 of the money is split into 3. So one of them is that the employee takes a pay cut for that third of the 2/3. The next tranche is that the company pays them anyway. And then the next tranche is that the government gives you that extra bit of cash. And when you break that up, that means the government is going to be paying just over 20%, it's about 21.66 recurring percent of the employee's total wages, which is why they get the 20% in SAYS as well, because they're saying they're making it roughly level to that. So this isn't the most generous scheme in the world. You're probably doing the maths right now, because you as a contractor, of course, you are the company. So you've got to pay yourself a third of it. Then you've got to just not be paid yourself by your own company for a bit more. then the government's going to give you 20%, and then your company does still need to pay you. So you can see essentially all you're going to get out of this is basically 20% of your salary. And of course, it's not going to take dividends into account, just like the job retention scheme didn't. So this is a way less generous version of the furlough scheme, essentially, and a bit more complicated as well. Now, this is complicated to explain. I hope I've sort of explained that okay-ish, but if you have any questions about it, put them in there and I'll try and explain it again and do it better. Maybe one of my colleagues can explain it better, but that is basically how it works. The state's contribution is £697.92 and does not cover pensions or NICS contributions. Okay. Employees can go on and off the scheme, so you don't have to work the same pattern each month. It's like more like the flexible furlough. It can change. So if you suddenly find that you've got lots of work in, then you don't need to make a claim that month. That's fine, that's great. But next month, if it drops off, you can make the claim. You'll also be able to claim the job retention bonus, even if you make use of this scheme. So the job retention bonus, to remind ourselves, is a one-off payment which goes to employers every time they keep on an employee who's been furloughed. So again, try and explain. So imagine a large company. Imagine Tesco's has laid off Andy Chamberlain, who worked for them, or not laid me off, put me on furlough because there wasn't enough work for me to do. Tesco's is a bad example because they had loads of work. Imagine I'm working at British Airways. Andy Chamberlain, the pilot, gets furloughed because there's not enough work for him to do. Now, if they keep me on and carry on employing me until the 31st of January, even after the furlough scheme has ended, British Airways gets £1,000 just for retaining me. That scheme is available to company directors as well. So if you keep yourself on inside your company, you are entitled to a one-off payment of £1,000, even if you make use of this job support scheme as well. So it's worth remembering that, because that could be a good bit of bonus money. Eligible employees must earn at least £520 a month on average between the 1st of November and the 31st of January 2021. That's for the bonus, the retention bonus, for the £1,000 bonus. Okay, I'm going to hand over now to Alistair, who's going to talk through the changes to the bounce back loans.
Thanks, Andy. And if people have been joining these webinars over the kind of summer months, last 6 or 7 months, how long we've been doing this, we've covered bounce back loans quite extensively in those, and we've got a good guide up on the website as well. So I don't want to kind of really go over all the new detail. I suppose just to restate, the key features of the scheme are that you can borrow between £2,000 and £50,000. The amount is capped at 25% of your total turnover. Government is guaranteeing 100% of the loan, and there are no interest or repayments due in the first year. After that point, there's a kind of 2.5% fixed rate. So really what the Chancellor has announced recently is sort of two changes to the scheme. One in terms of the deadline. So that has now been extended from the 4th of November to the end of the month. So you've kind of got, you've got up until the 30th of November to make use of this. I have seen quite a few stories on BBC News website today and in the Financial Times as well about, it's been a bit of a story the whole time with the bounce back loans recently. A lot of the banks and lending institutions are, coming under quite a lot of pressure for just not getting the money out to people fast enough, and there's been a lot of changes to their lending criteria. So I think although there are still technically 28 accredited lenders for this scheme, in actual terms, there's quite a few that have stopped accepting new applicants, and there's others that have kind of introduced a few onerous checks. So, I mean, the thing to counter that with is, approval rates are still above 80%. So compared to the other loan schemes that the government's running, this is one where you have a good shot at it, but it's certainly not a kind of, a home run in terms of the ease of applying. So the deadline has been extended. And then for those who have taken out bounce back loans, what the Chancellor has announced is what he calls pay-as-you-grow options for paying it back. And really, this is just to build in more flexibility to the repayment terms so that it's a bit easier for borrowers to pay the loans back kind of as and when their business is coming into better periods. So the three things they've done, firstly, is you've now got the option to repay the loan over 10 rather than 6 years. This in effect reduces the monthly amount that you can pay back. The other options, as I've noted there, you can move temporarily to interest-only payments for periods of up to 6 times, and this can be used up to 3 times. And you can pause repayments entirely for up to 6 months. Now, you can only use this one once, and you can only do that after having made 6 payments as well. But as I say, the idea is really to just build in a bit more flexibility so that if you're borrowing, you don't feel that you have to, be as constrained as you would have been under the initial terms of the scheme. So that's really it for bounce back loans, and the similar extensions have been made to the CBILS, the coronavirus business interruption loans, but as they're kind of slightly targeted at larger SMEs, I've just not focused too much on that for now. And so, if you want to go to the next bit. And so the kind of second, set of amendments that the Chancellor's made, again, similar story really to SAYS and the job support scheme. A lot of this, as much as the Chancellor was saying he wants to be creative and look for new solutions, a big part of this winter economy plan is really modifying and tweaking the phase 1 coronavirus support. So 2 things in particular to note for the self-employed that were in addition is the new payment scheme for VAT deferrals. So you will remember that back in March, businesses were given the option to have an automatic deferral of VAT payments that were due between March and June 2020. So basically now they are being given the option to spread those payments out over the next financial year. So rather than paying in full at the end of March 2021, you can choose to make kind of 11 equal installments without any interest owed on those over the next year. The slight difference between this offer and the VAT deferral that was put in place earlier in the year is that you'll need to opt into this. So it was an automatic offer back in March. This is one where you'll have to kind of put in a particular application, and HMRC say that they will kind of have the process up and ready by early 2021 for you to do this. And of course, if you use that deferral, but you now feel that you're in a position to pay off that VAT that you owed earlier in the year, then of course you can pay that as it's due in early next year in 2021. And the second part of the kind of tax deferrals landscape was enhanced time to pay for self-assessment taxpayers. So again, on plenty of these webinars before, we've talked about the HMRC's time to pay arrangements. These are where you can kind of arrange a sort of bespoke, tailored agreement, or where you can pay back tax that you owe HMRC in installments. And so what the government has done is, again, just building on that tax deferral for payment on accounts that was due in July 2020, you can now arrange a plan to basically pay that back in monthly installments until January 2022. So that is both the deferred July payment that you had and also any additional kind of new tax that you would normally be paying in January next year as well. So you can kind of defer your whole amount that you're due then as well. And they've also increased the kind of threshold at which you're able to make use of this scheme. So previously it was available on self-assessment payments up to £10,000. That has been increased to £30,000. There is one element of this which, at IPSE we're not particularly happy with, and I think is something that was, it's not obvious on the face of it. It certainly didn't come into the Chancellor's statement, and it's not particularly clear in terms of the guidance that they've published on the website. But from what we've read, basically, despite the offer to help people out and defer the taxes in this way, the government is still saying that interest will be applied at 2.6% to any outstanding balance from 1st of February next year. So really, it's a bit of a kind of carrot and stick, I think, this. And I think given the fact that with other loan schemes, whether it's or with other kind of business support schemes, whether it's the bounce back loans being interest free for a year, whether as with this VAT deferral, that is interest free as well, it seems a bit harsh to us that they are still applying the kind of late payment interest penalty for taxes due to HMRC on this as well. So I think that's something that we will be raising with the Treasury in the next few weeks. But really, that's it. So a few minor extensions and tweaking of bounce back loans and a bit more flexibility with tax support as well. But I'll hand back to Andy now just to wrap up in terms of what IPSE's focus is for the next few weeks before we get into questions.
Thanks, Alistair. So look, as I've said throughout this, we were pleased that SAYS was extended. We didn't know that it would be. I wasn't actually expecting it at all when the Chancellor stood up and spoke. I thought we were going to hear lots about the new furlough scheme or some extension to that, which of course we did. And we were preparing ourselves to say, you've forgotten about the self-employed, and put out a big statement. So when he said we're going to extend the SAYS scheme, we thought, okay, great. But the 20% is a concern. I think that, we're going to have to think about people who have been living off the grants are not going to be able to continue to live off that if it's just 20%. So that's going to be difficult. And also, I think probably the most important thing is that the scheme does nothing for those who were excluded the first time around. And just a couple of questions that I've been jotting down. Rudiger has asked, does the Alan asked, does the SAYS extension now cover limited companies? No, it doesn't. If you work for your own limited company, SAYS, you're not eligible for SAYS. You can make use of the job support scheme, we think, but it's not explicitly stated anywhere, but we think that that is the case. But as I've said, that's going to be not all that generous. Mind you, neither is SAYS now. But also because of the fact that it doesn't take into account your dividend income, that's the crucial thing. As just in exactly the same way that the furlough scheme never took into account of that. It's not generous most of the time for company directors, because most company directors do get a lot of the money that they pay themselves in the form of dividends. But no, the answer to the question is no. The new SAYS extension hasn't changed on limited companies. Alex has asked, is it going to allow people who were working since April 2019? In other words, they can put in their 1920 tax return. It says no. Government's still not doing that. So if you're new to self-employment, even though that tax year ended in April, we've had plenty of time for people they could do their tax return. We could give them a new deadline now, couldn't we? We could say, get your tax return in by the end of October, and you can be eligible for SAYS for this second round of it at least. No, that's not happening. So this is the big disappointment for us. And the 50k cap too, why not introduce a taper? Like we've always said, we really do feel that there's an opportunity missed here to actually look at some of these gaps and think, how can we fill these gaps? So that's the big problem we have there. We've written to the Chancellor and we said, look, what we need is focused, flexible and fair SAYS support for the self-employed. And when we say focused, what we mean is let's try and get money into people who really need it, regardless of whether they're new to self-employment or whether they're working for a limited company or whatever it is. If you've got a pot of money you're going to make available to the self-employed people, let's target that, let's allocate that where it's most needed. The problem with the first SAYS scheme, indeed with this SAYS scheme, is that it didn't help lots of people that really needed it. And it actually did help quite a few people that didn't really need it. There's lots of people who were doing okay. Perhaps they live with a partner who's had steady income coming in. They just got the payment. It just automatically happened. It's like, yeah, you qualify, you meet this arbitrary criteria, you're in, here's a payment, potentially a few £1,000s. Whereas there'll be someone else over here who's saying, I have nothing. I am desperately worried. I'm going bankrupt. Everything is falling apart for me. Oh no, you don't meet the arbitrary eligibility criteria, so you don't get anything. And that's the problem with SAYS that we feel wasn't addressed initially and now hasn't been addressed at this second round as well. So that's disappointing. Flexible, because we're saying why not be able to turn it on and off? If someone can do a bit of work here, a bit of work there, then rather than it's just all or nothing, then we might be able to allocate it better. You can take that pot of money and separate it out a bit better. And fair, because, well, that again goes back to the eligibility criteria. It's not fair that certain people just can't get it. They're just locked out of it. So let's look at that and make it fairer. And include the dividend income for the JSS as well. If that's where the contractors are going to be put, if you're working for your own limited company and you're making a calculation based only on their salary, that's not the full picture. So let's include the dividend income in that. Now, actually, I asked a question of the Chancellor yesterday evening at the virtual Conservative party conference on dividends, and I have to say that once again he just sort of knocked it back. It seems that this is not an issue which he is willing to look at, despite the fact that we have, written to him on several occasions. We've made the case that it could be done, and we were backed up by the Treasury Committee, who put it in their report, actually said, look, IPSE's got a solution to this, why don't you implement it? And the Chancellor responded to that report as they responded to us last night and said, we're not going to do this, it's too resource intensive. So it's very disappointing. We're not going to stop going on about it, but I don't think anything is going to change there soon. Now, speaking of the Treasury Committee, we're back there in 2 weeks' time. Our CEO, Derek Cribb, is going to be giving evidence not around coronavirus support, but I suspect it might come up. It's about tax after coronavirus, this inquiry. We've submitted evidence to it, and you should be able to watch it online. It's on the 20th of October, 9:30 in the morning. I'm sure it's going to be streamed live. You can go onto their website and see it there. And we're going to be talking there about some interesting ideas we've had about reforming the tax system to help self-employed people as we emerge from COVID, help self-employed people to drive the growth the economy is going to need by sorting out the tax system. And by the way, IR35 is in our minds very much. We're thinking, let's make some changes so we can just get rid of that, because it's such a big problem for everyone. And we have had a question on IR35, but I'm not going to sort of go on it. But John, I am aware of that PwC guidance on IR35 compliance for companies. You're right, they are doing the right thing there. We also want to hear from you. How is your business coping during the coronavirus? You can let us know in the questions here, but you can also email policyqueries@ipse.co.uk and tell us what you'd like to see the government doing to help people, because someone might have a better idea than we're having, or come up with a great argument that we haven't yet made that might just help us to sort of crack that door open a little bit more. I'm just going to move on to the next slide here around, just to let you see these links so that you can sign up to our newsletter, check out our website, and we've got our FAQ page as well, which we're keeping updated on coronavirus support. As I said before, we will be keeping that updated because there's still things that aren't totally clear about some of these support packages. Sorry, Ryan, what were you going to say?
I was just going to reference a couple of questions, because actually one of those links obviously goes to our FAQ page, and Gareth has asked about local government support to supplement your income for freelancers that can't access other help from the government. And on that FAQ page, Gareth, you'll see there'll be links to lots of local council and regional support. So if you're in Wales, Scotland, Northern Ireland, there is other support available, and a lot of councils, all councils in England have had a smaller amount of money from government in order to help companies, and some are better than others, but so it depends where you live, but that should be available on your local council website. And there's a couple of other quick questions to answer. I know there's a lot to get through, so I'm just going to rattle a few off. Steve, I think was probably the first proper question we had. Steve Butler, are you able to pay deferred VAT in instalments? You are, Steve, and that's correct, Alistair. You can pay VAT. I think, is it 11 instalments?
Yeah, that's correct. Yeah.
And then Rudiger asked, does the grant need to be paid back? Now, of course, as a grant, you don't have to pay the money back to government in full. It is a grant, but as we've made very clear, as much as possible, that will be taxed at the end of the year, part of your self-assessment. So you'll effectively be paying some of that money back. But
yeah, it's a taxable grant. The SAY scheme is a taxable grant. That's absolutely correct. Interestingly, Delphine's asked a question about that. It said, in the next tax return, will the grant come under net profit, or will it be itemized separately? And she says, I'm asking this in the context of remortgaging. So quite a lot in that question. I actually don't know the answer, Delphine. I rather suspect that when you come to do your tax return online for this tax year, they might say, did you receive a payment from this scheme, as like a separate question, and itemize it out separately. I rather suspect that might be the case, but I don't know. I don't suppose that's been, I suspect that hasn't been made clear yet. because people haven't yet done those. You know, we're still in the same tax year that you've received any grants you've received through SAYS. You've received them in this tax year. So, but when it comes time to do the next tax return, it might be the case that that's going to be itemised out separately, but I don't know for sure. Any other questions that anyone's noticed?
I've seen a couple to do with bounce back loans. So I think one of them was around whether these kind of new things, such as the 10-year option rather than to pay over 6 year, whether that's automatic or not. I think actually we're still waiting for government to clarify this, but I did have a bit of a look on some of the lenders' pages, so Barclays and a couple of others, and I think my understanding is the intention is these are things that you have to discuss with your lender, and then you will come up with a kind of new repayment plan. So I think if you've already taken that loan out, you'll have to have that conversation with the lender to make use of some of these options. And there was another question which was around what is the qualifying period for turnover for the bounce back loan application. So even though the deadline has been extended for applications from the 4th of November to the 30th, I think the main eligibility was that your business had to have been established before the 1st of March this year. So again, it may vary depending on the lenders, but I think most were looking at your turnover up until that point. So if your circumstances have changed since then, I doubt you would be able to kind of go back now rather than a few months ago and kind of seek a sort of more favourable loan based on the higher turnover you might have accrued. I will double check that, but I think that's my understanding of those. And just a final thing, because Ryan mentioned there the local government support as well. I think this is something at IPSE we've touched on it in webinars, and we've been kind of critical of government again on this. So a lot of local authorities, as Ryan said, have been given grant funding by government, and it is discretionary as to what they can use that for. So to us, that suggests that is a very good opportunity for them to use it, at some of these kind of excluded groups that have missed out on the main sources of funding. Unfortunately, government has slightly tied their hands in some ways by saying businesses that are paying business rates, i.e. ones that have physical premises, should be prioritised for the distribution of those grants. Again, I think that's a bit of a missed opportunity, but I would say if you have not had any support at all, it is absolutely worth checking your local council website and even getting in touch with them, even if the deadlines have passed for the first block of grant funding. Because again, as part of this winter economy plan, I think the Chancellor said he would be giving a kind of another 5% boost to this local authority grant funding. So I suspect there will be another batch of local funding available. So absolutely worth getting in touch with your local authority if you really are kind of in dire straits and in need of financial support.
We've had a few questions on something which I think is quite understandable that Andy has touched on, which is about actually calculating your hours for the new job support scheme. So, I mean, how do you calculate it in order to pay yourself some, get some from the government, etc., etc.? And there has been in the news quite a lot recently. As soon as the scheme was announced, that it's quite a complicated calculation you have to make, because you're potentially over. It's very long-winded. I don't know if you want to touch on that again, Andy, because I think you know a bit more than I do. But there's been quite.
Yeah, so it sounds to me like the question that you're asking there is how do you decide what percentage of your normal hours you've worked? Well, I think you just have to set out what your normal hours are. Even if they do fluctuate quite a bit, just choose something which seems sensible, and then you just work it out on a percentage basis. So if you work 2.5 days of the week, then you've worked 50% of your hours. So you'd have to pay yourself the salary part of your payment to yourself, 50% of it, and then the remaining 50% would be split 3 ways between you not being paid by your company paying you anyway, even though you're not working, and then the final third would be the government chunk of it. We have had a couple of questions in, one here from Jill, and I think I saw the same question somewhere else, saying, could the company choose to pay the employee fraction so that the employee gets the full pay? So that fraction where the government's saying, well, the employee will just take a hit, just be paid less. can the company pay them that bit anyway, but still access the government contribution in the same way? I actually don't know the answer to that. I don't know if any of my colleagues do, but I suspect the answer is yes, the company could choose to pay them, because that's what they did for the furlough scheme. The furlough scheme paid the employee 80%, but the company could top that up with the extra 20%, so that the employee has the full pay. I suspect that will be the answer here, but I'm not 100% sure on that one, Jill. I will go away and check, and I will put something up on the website about it. Brian's asked a question: does the £520 per month include or exclude the government job support scheme contribution? So this is about the job retention bonus. This is the £1,000 that if you've been furloughed and then your company retains you up until the end of Jan, you get the £1,000 bonus, job retention bonus, but you have to pay yourself £520 a month to do that. And Brian's saying, well, what if part of that 520 is made up of the JSS contribution from the government? I'm pretty sure, Brian, the answer is it's okay if it is partly made up by the JSS. I don't think the JSS application impacts the job retention bonus. But again, it's something that I'm not 100% sure about. I will have to check it, but I think that's the answer.
I've seen a couple of questions relating to corporation tax and whether that can be deferred. So this isn't something that the government has made a sort of automatic offer in the same way that it did with VAT. But the short answer is still yes. So you would have to go through the government's kind of coronavirus helpline, use that time to pay service that HMRC has. But this is something that you yourself will have to, speak with HMRC and negotiate with directly. I think in our FAQ page we've still got the correct number and link to the kind of web chat service for HMRC for you to just go straight and do that. But yeah, the short answer is yes, there is a way of deferring your corporation tax payments, but it's not a kind of automatic offer that's been available in the same way that the VAT or the July payment on account was as well.
Sarah's asked, as a sole employee company director, am I eligible for the job retention bonus even if I didn't furlough myself? I'm afraid, Sarah, the answer is no, you are not eligible for that bonus. The job retention bonus is only about furloughed employees being retained by the company. If you weren't furloughed, then you can't make use of that, I'm afraid.
I've done a little Googling, and also someone has dropped into the questions box. Nick says that his accountants have said that you can't top it up, and I did have a quick look at the some accounting advice, and yes, it's very unclear still, but there seems to be some agreement online from some. I went on Accounting Web, for instance, which is a fairly reliable website, that actually companies won't be able to top up on top of the JSS contribution. Right. I suppose if that is correct, I guess the rationale behind that is that if you are able to top up on top of what the government are topping up, then you probably are able to pay people more of their wages anyway. So I guess that would be the rationale, but we need to find out some more detail because I'm still not entirely sure why.
Yeah, it sounds like there could be some. Yeah, I mean, a lot of this stuff was announced, and there wasn't very much guidance put up around it. Now, I think that guidance is coming in, but there's still a lot of questions about a lot of this stuff that we're also asking the Treasury of. So we will come back and do another one of these webinars in the next couple of weeks when we know a bit more to try and answer some of these questions that we can't give definite answers on right now. And apologies that we can't. But perhaps my answer on that one. Take it with a pinch of salt, check it out, ask your accountant. I don't want to give wrong advice. I'd rather give no advice than wrong advice. Okay, Mark's asked here, am I eligible for a payment under the job retention scheme if I choose to continue paying myself 100% of salary? Yes, I don't think that's going to be impacted by that. Yeah, so if you choose to just keep paying your whole salary, Mark, in other words, you're not going to make use of the job support scheme. But if you were furloughed before, then you can make use of the job retention scheme, even if you don't make use of the job support scheme now. So the job support scheme is separate to it. You can still get the job retention scheme. God, all these acronyms. Yes, you can get the bonus, I believe.
This is one almost that I've just kind of has occurred to me. One for kind of Andy and Ryan. So there was a kind of interesting thing that the Chancellor said in his speech, which was that I think for the what is now the fourth and final SAYS, which comes in early next year, that he would be keeping elements of that under review. Now we've had again a kind of a few questions about people who are newly self-employed, would be able to kind of apply for a SAYS if a 1920 tax return was taken into account. Kind of open question as to what do you think the Chancellor's thinking is there in terms of keeping it under review? Is he keeping it under review to the extent that it would just be another extension, so on the same terms, a kind of fifth instalment depending on coronavirus, or is it actually a bit more, we might have to look at the eligibility of this if it's another tax year past, there could be a kind of new cohort of people that we could get in?
I think that when he says keeping it under review, I think he's thinking about the 20% more than anything else. So I think he's saying that percentage contribution could change. I'd like to think that he might also review the eligibility criteria for things like newly self-employed people who didn't have an 18-19 tax return because they weren't trading then, and indeed maybe even for limited companies too. But I doubt it. I doubt that that's what it seems to me that they've shut that down. Now we think that's completely wrong, and we will continue to make that point. But I'd be surprised if he comes back. Previously, I had thought they might come back and look at some of that eligibility criteria. But now that he's announced this extension without any hint of a consideration of that stuff, I'd be surprised if he then thinks about it in 3 months' time, or indeed, as I think you're suggesting, Alistair, in 6 months' time, once we've had this next 2 grants paid out over this next 6-month period. If there is going to be another extension, then what will that look like? I mean, that is quite far in the future, so there's a lot of ifs and buts, and maybe, who knows, there will be an opportunity there to sort of open this up a bit. But right now, I don't think anything's going to change on the eligibility criteria in the after the January payment for SAYS has been made.
If you actually go and look at the very thin and not exactly detailed in terms of traditional Treasury outputs, the fact sheet that was released with his speech, the review bit does come in the paragraph which specifically references the amount. So I think that's probably, and perhaps I'm being a bit pessimistic, but the government also have a bit of form in terms of lowering the amount that is available over time for both schemes. So I think it is the amount. Although in terms of the tax return, the logical argument against including the last tax return becomes increasingly outdated every single month, and the closer we get to next April, I think that argument becomes much less watertight. Going back to the questions, Alistair, I think you're probably the best person for this, but is there a deferral, Philip has asked, is there a deferral on paying company tax? And I think he probably means corporation tax for those of us working for limited companies. So can you defer your corporation tax payments?
Yeah, I think so. We've covered, I think, that one. Yeah, I think the answer is it's not an official kind of government offer in the same way that some of the other tax deferrals were. But yeah, if you even just Google HMRC time to pay or COVID-19 helpline, you should be able to find the way, because it is stated on the website. They've got this facility set up, which is if you're in a bit of financial difficulty, you think you're not going to be able to pay some of your taxes that you owe on time, including corporation tax, then yeah, you can make use of that and come to kind of a tailored arrangement, probably to pay that out in installments over the next year instead.
Stephen has pointed out something around the 23rd of January, 23rd of September, sort of deadline date for being on the payroll in order to make use of the JSS. Now, Stephen, we've also seen this that you've helpfully sent us a link to, which is from the gov.uk which you helpfully quote here, so I can read it. It says, employees must be on an employer's PAYE payroll on or before the 23rd of September 2020. This means a real-time information RTI submission notifying payment to that employee to HMRC must have been made on or before the 23rd of September. And I think this is a big problem for many people, Stephen, as I said before, because I think that a lot of freelancers just pay themselves one salary payment a year and often do it at the end of the tax year. What I'm not clear about is if you made a payment in the last tax year, whether that will enable you, because it doesn't say anything there that you must have done it since April the 6th. And this is what I was trying to seek some clarity on. In fact, I have asked Treasury to clarify this point. I am worried that, I think as you are, that this will mean that if you haven't had an RTI event before the 23rd of September in this tax year, you can't make use of the JSS. So that's a big, it's a big question mark over whether this is really going to be useful for a lot of contractors. Some contractors pay themselves more frequently as a salary payment through the year, so that they would be all right, but many don't. And so they would be, if my concerns are right, that if you had to have made a payment to yourself between the 6th of April and the 23rd of September this year, then that's going to catch out a lot of people. So I'm worried about that, and I'm seeking urgent clarification on that one. But thanks very much, Stephen, for sort of pointing that out. Okay, we are getting towards the end of time now. Is it, Alistair and Ryan, have you noticed any other questions that we could quickly answer?
I think we've covered most. I think maybe, you know, we've, as Andy mentioned, we've updated our FAQ page on the website, which has kind of the details of all this. We may in the next couple of weeks publish something, you know, really specifically as a sort of standalone article on the job support scheme for directors, because I think there's so many bits and pieces to, you know, the technicalities of how you might use that might be a useful thing to put up. I suppose, but the main thing, which the only other kind of few questions that I've seen come in, and there was one or two that we had in advance, but really just about those people who, you know, have not been able to furlough themselves, those who have missed out on SAYs, those who don't occupy property, so people who do really fall through the gaps in support and really what's available to them. I think the main things are, you know, depending when your business was set up, the bounce back loans, they could be an option. If you have tax due, the deferrals again could be an option. Universal credit is something that we've touched on in previous webinars as well. And I would just reiterate, you know, the local authority funding option as well is worth keeping an eye on and worth checking with your kind of local council website as well. And also within your industry as well, I've seen a couple of people with questions as they work in, you know, events or the creative sector. There are a lot of industries that have been setting up kind of local hardship funds or sectoral hardship funds. You know, really try and just have a look at everything that's out there. Really just to kind of encourage you there. You know, it is incredibly tough if you have missed out on the SAYs or the JRS, but there are one or two things that you might still be able to use.
Thanks. I'm just going to quickly mention one other question that I've noticed, and I've now lost it. But yeah, I think it was Stephen saying, I have read that any employer as directors making use of the JSS would not be expected to draw any dividends from their company while they're making use of that. And do we have any knowledge of this? I don't have any knowledge of that one either, but I can imagine why a rule like that might be put into it. And that's another thing that we'll have to look up, Steve. And I think that what's becoming clear is that we need to get answers out of Treasury to answer all these different questions we've had here, which has been very useful to have the questions. I'm sorry we haven't been able to answer definitively a lot of the questions. I hope that you found what we have been able to answer useful, and we will put up more information on our website about, particularly around the job support scheme and company directors, because there is a lot of outstanding questions there, and I understand that. Okay, well, thanks very much everyone for joining us today, and thank you to my colleagues Alistair and Ryan. We hope that you've found this somewhat helpful, and as I say, more information will be coming from IPSE, so do keep checking back with us. Thanks very much. Bye.